happens.
Top pick number one, Intact Financial, the big insurer.
Yeah, so Intact Financial, one of the good things we've done this year was adding Intact to our portfolio, and it's a company we followed for a long period of time. We mentioned Manulife earlier. This was one of those names that I think is a great replacement for a Manulife in your portfolio. It significantly created a lot more shareholder value over the last 5 years than Manulife. So Intact has been grown by acquisition. It's the largest P&C insurer. They have aspirations to have insurance in the hands of 1 in 3 Canadians, but they're also expanding outside of Canada now. So they made an acquisition of a company called RSA, which has a big UK presence.
Scandinavian company, was it? I can't remember. Anyway, but big in Europe.
They have a big European and UK exposure specifically, and so they're taking a lot of these businesses now, and they're cross-selling. They're getting synergies from them, generating enough cash flow to reinvest in the business and growth, but also reinvest in more acquisitions or M&A down the road. So we really like this company for its stability. Its valuation is always around 2 to 2.5 times, so it's right in that wheelhouse right now, but you're getting a much higher return on equity. So they've historically been about 500 basis points higher than the industry. So you're talking about a mid to high teens ROE potential with this business. So they're continually creating value for shareholders from dividend buybacks, buying back the dividends, buybacks on the stock, and reinvesting smartly in the business. So excellent capital allocators, a great company to hold in a period like now where you're looking for predictability of earnings. This is the answer to that.
Brookfield Infrastructure.
Yeah, so talking about utilities being hammered in the last week or two, Brookfield Infrastructure Partners has certainly been grouped up with that, which we find really interesting because this has become one of our largest positions in our Aventine dividend fund because we think there are so many tailwinds to this business. If you're driving through a recession and you want to pick one management team to be driving that car, it would be the team at Brookfield Infrastructure Partners. They're great capital recyclers. Their assets are mission critical. There's a huge spotlight right now on these infrastructure assets, and they have a lot of inflation protections built into these assets. So their cash flow actually grows during these periods. So from a free cash flow perspective, it's growing, dividends growing, assets are becoming more reasonably priced, and they'll be able to sell assets as well at higher value if they want to recycle them. So, the valuation disconnect right now doesn't make a lot of sense to us, and so we're adding to this name at these levels.
And then Fortis has been increasing the dividend steadily for decades.
Yeah, 49 years, I think, they've increased their dividend every year. And so right now, what we're trying to find in our portfolios is companies that don't have huge risk to negative estimate revisions. So right now we're sitting here, we've had this rapid rise in interest rates. It's impacted the utilities valuations, which is why we think it's attractive. But the next step is going to be as companies report their Q3, it's what happens to earnings estimates. And maybe they stay the same, maybe they come down, maybe they go higher. But we think there's higher probability that estimate revisions are going to decrease. So we're trying to find some stable, predictable companies to own for our clients that will weather the storm. And when you look at it on a relative basis, companies like Fortis will really shine because they'll continue to put up consistent, stable results.
Right. I'm just looking at the dividend yield right now, about just over 4%.
Yeah, it's just over 4%. The valuation has checked back after, when you go through a period of high volatility, investors flock to the consumer staples, to the utilities, as we know, all the defensive sectors. And so that got the multiple to a level that was a little bit more unsustainable. But at these levels, you can recharge and start adding Fortis to your portfolios again. It's very well diversified. They've got business in the U.S. from transmission to production of natural gas. They've got a lot of great assets in Canada as well. So it's a very well diversified regulated utility.
I'm looking here at the 10-year return as calculated by Bloomberg, and they say that including dividends, you've made almost 130% from Fortis, whereas on the TSX broadly, you would have made 109%. So less volatile, I'm guessing, along the way.
Yeah, it's much more predictable. The earnings variability here is very, very low. And there's not a lot of funding risk with this company as well, which is typically the big overhang that you get with utilities.
Yeah. And what about company? I mean, so obviously a big dividend payer. Are you wary before you buy a stock that doesn't have a dividend? Does that turn you off?
Yeah, well, it depends on the strategy. So we have three different equity strategies at Aventine. And we have a core strategy, a dividend growth strategy, and our Canadian equity fund, which is an all-cap strategy. And in the all-cap strategy, it's not a big factor in how we look at companies. But one of the common threads throughout all of them, which is somewhat related to the dividend, is just own companies that have good balance sheet and generate lots of cash flow. Those are key tenets across all of those strategies. But you have to be, if you're not paying a dividend, then there's going to be a little bit more volatility there with the stock that you have to pay attention to. Because all of a sudden, if you pay a 6% dividend on your stock or have a 6% yield, and that shoots up to 8 or 9%, investors start to use that as a valuation tool to get it back in check. But if you have no dividend, it can get the valuation to all sorts of levels that you never thought possible, like we're seeing right now in 2022 with some of these non-dividend payers.
And what about these big stock, sorry, we're tight for time, but big stock buybacks? I know it depends on the company, but are you happy generally when you see that?
Yeah, it's a tax-efficient way to give money back to shareholders. You know, of course, we would rather companies go out and deploy that capital on acquisitions or internally to generate a higher return on equity if they can. But it's a reasonable way to provide capital back to shareholders.
Okay.